Hello, I'm Kamal Santamaria. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and finance. This week, power to the people. Zimbabwe claws back its mines from international investors. It'll give President Mugabe invaluable funds ahead of elections, but at what long-term cost? It pays to be with Putin. We peer into the inner circle of the former and soon-to-be president of Russia. And the story of another European country which flew too close to the sun, but Latvia survived the fall. We find out how from the country's economy minister. Hello everyone, we went big on South Africa a few weeks ago here in Counting the Cost. Now it's neighbour Zimbabwe and a business deal with all sorts of political and economic implications for a country with its fair share of political and economic problems. The story involves the world's second biggest platinum producer, Impala Platinum. It's a South African company which has interests in Zimbabwe too. Only now they've been forced to reduce those interests because the Zimbabwean government's demanding 51% of ownership be in the hands of black Zimbabweans. They call it black empowerment, something which has really dominated President Robert Mugabe's 31 years in power. He's fought endlessly really to remove what he considers the remnants of white rule in what was once called, Southern Rhodesia. Critics of this plan, though, say it only emboldens Mugabe's Zanu-PF party ahead of elections. Why? Because despite the outline of a unity government, there is a crucial split in Zimbabwean politics. You've got the MDC, the Movement for Democratic Change, which controls the finance ministry, which reduces the power of Mugabe to print money. But Mugabe's party, Zanu-PF, runs the mining ministry as well. If it holds sway over those, it could fund its patronage system through 51% arrangement. You may remember a similar situation when it seized the white-owned farms. I hope that sort of explains the situation for you, as we call it black empowerment. And as such, Zimbabwe even has an empowerment minister, Saviour Kasukwere, who joins us now from Harare to talk through this issue. Minister, thank you for your time. Zimbabwe, indeed any country, needs a mix of indigenous business, local-run business, but it needs foreign investment too. Isn't this sort of empowerment law actually going to scare off foreign investment and possibly further isolate Zimbabwe?
Well, basically what we're doing now is to bring about that mix. We need to be able to work together, the local business persons and the foreigners. And that's exactly what environment we are creating, where there is a shared growth, shared partnership, and the shared opportunity. The policies that we are bringing about will allow our foreign investors a lot more security. They cannot continue in the old ways where they only own the 100% of everything, and our local people remain in abject poverty. I think that type of ownership is archaic and cannot be accepted anymore.
Okay, so tell me about this 51% arrangement with Impala, the specifics of that. How much negotiation or indeed persuasion, if I can use that word, did it take to make them agree to this 51% local ownership?
Well, we have been engaging with Impala for quite some time. Let me say that from day one, I think the agreement which we drew up as government earlier on, around 2006, was to a very large extent a very defective agreement. But however, I want to say that we have been engaged in a constructive way with Impala. We announced our agreement in principle to the 51% plan which they brought to us. We're still studying the final details of their plan, but we have also agreed on setting up a joint technical committee which will now just work on the nuts and bolts of the entire deal. But what we're happy with is that 51% will now be in the hands of institutions or entities that are Zimbabwean, meaning that the greater benefit will accrue to our people, will accrue to our nation, and this will go a long way in supporting and ensuring that our communities as a country do develop.
You call it, and this is a bit more broad-based here, looking at the law, not just this Impala deal, you call it black empowerment. You are the minister for that very reason. Are Zimbabweans actually empowered these days in their everyday life? I was in Zimbabwe 4 years ago for the elections, covering it for Al Jazeera. I clearly remember long queues of people each morning just trying to get basic bread. The crazy money situation, you had the billion-dollar notes, trillion-dollar notes. They were not an empowered people back then. Are they actually any better off now?
Well, precisely. Though this is why we have to carry out these policies and laws. We cannot allow a situation where when foreigners get angry with us, our people start suffering. What you have talked about was evidence of an economy that was controlled largely by foreigners who decided at what point they would twist your arm, at what point they can impose sanctions, and you cannot defend yourselves. It is important for any nation to take control of their economy if they want to be able to look after their people and not be susceptible to foreign interests that subvert the interests of their country. So what you saw about 3 years ago in Zimbabwe was again a situation where we had embarked on a land reform program, and there was pressure against the policies that were taken, and our people were made to pay a price through sanctions and other things. And what we are now doing is we are fortifying our economy. It is our people who must be the center of production. It is our people who must be able to drive our national economy so that we do not again find ourselves in a weaker position like we've been before.
Okay, fortifying the economy for the future, entirely understandable. What about right now, though? How does Zimbabwe actually plan to pay for all of this?
Exactly, but this is the building process. Well, we have said we have set up a joint negotiating team, which is now looking at the amounts. And let me say to you, remember, the biggest asset when we talk about these businesses is our resources. For as long as everybody in the world appreciates and understands that when you are in Zimbabwe, especially in the mining sector, the biggest asset you are talking about is our subsoil assets. And those belong to us. They don't belong to foreign investors who come. You can bring your Bell equipment, Caterpillar equipment. It doesn't give birth to platinum. What gives birth to platinum is what God gave to our people and to our country. And that is what we are saying belongs to us. So when it comes to payment, we are very commercial. We are dedicated and committed to coming out with a commercial transaction where we place our value on the table, and we expect our partners to place their value on the table. The numbers are there. There's what we call resource value. There's what we call improvements and investments. The numbers are there. They've filed their numbers, the tax department and everything. We all are now very much financially literate to the extent that we can sit down on the table and come out with an answer that is basically a modern answer to a modern challenge.
The cynics would say this is all just electioneering. It's an election year, Zanu-PF needs to shore up support, and this is a good way of doing it. How do you react to a charge like that?
Let me put it in this way, two things. Electioneering. Any nation, any political party must pursue policies that allow it to win an election. And it would be foolhardy for my political party and our government to pursue policies that make us lose elections. So if you are going to look at it from that angle and say we're doing it because of politics, fine, we're in politics. I'm a politician. So whatever I do is in politics. It's about elections, yes. I would be foolish to pursue policies that make us lose elections. It would be totally stupid. But secondly, again, in terms of this policy, we have said we are empowering our people, and we're making no apology about it. So if somebody says it's just electioneering, well, shares are going to be exchanging hands, and some people will be saying we're electioneering. Our communities are getting empowered. People are saying we're electioneering. Well, electioneering is part of the life. It is politics. But more importantly to us, it is the benefits that must accrue to our people. If our civil servants today are being financed by the process coming from Marange, where is the electioneering there? We have to look after our people. This country is under sanctions. We can't afford to leave again our economy exposed to the pressures that can be put on bear to our nation by foreigners.
That is Savio Kasukwere, Zimbabwe's Empowerment Minister, joining us this week from Harare. Thank you for your time, sir.
It's my pleasure. Thank you very much.
And still ahead this week on Counting the Cost, just what is driving Libya's economy now? Not oil, but subsidies. And it's distorting the economy and increasing corruption. That story to come just a little later on. Right now, though, we turn to Latvia. Now, this is a country you do not hear much about, but its recent history is actually very similar to that of so many European nations we've been talking about for years now. The difference is Latvia is recovering very well indeed. Latvia was actually an example of how the European Union was supposed to work, and it did rise really swiftly. It also fell hard, though. Have a look at these numbers. After joining the EU in 2004, Latvia's economy grew at the fastest rate in Europe, averaging 11% from 2005 to 2007. Real estate prices, they grew 240% during the bubble. It contributed to a current account deficit of 22% of GDP. Credit was easy, life was good. until 2008, when everything stopped. The credit dried up, the export markets collapsed, the IMF and the EU stepped in and bailed out the nation to the tune of €8 billion, around $10.5 billion. Some of the harshest austerity measures in Europe followed. GDP shrank 18% in 2009. Unemployment rose to 21%. It was a nasty, nasty story. But Latvia is coming back now. And I had the chance to chat to the country's Minister of Economy, Daniel Pavluts, to find out what the country had learned from their rapid rise and fall.
Well, certainly the crisis was quite hard on us. It was not just the financial crisis that hit the rest of the world. It was actually homegrown crisis, which was a full-blown real estate bubble and a consumption-driven economy, which grew very fast. Actually, was the fastest-growing economy in the European Union for a couple of years in 2006-07, and then we really crashed into a wall with a sudden credit stop, and the previous model basically fell apart. So
it was a private sector story rather than the public debt which we're seeing elsewhere?
Absolutely. We have had no sovereign debt crisis whatsoever. It was really private sector debt which basically became unsustainable in terms of what the structure of the economy was.
Unemployment was huge, austerity measures were harsh, and yet we didn't see the public turn as badly as they did in, for example, Greece. I think Greece is the example we always look at. What was different there? If the austerity measures were that harsh, how did the people cope with it?
Well, I think one of the reasons was that, first of all, we are a post-Soviet society, in the sense that we have gone within the existing generation even. We have a living memory of very harsh times. Believe me, 1995, when we were going down after Soviet Union collapsed, before we began picking up again, that was also very, very difficult as we were introducing market economy. So this crisis was not the first in a lifetime for most of our citizens. The policy response, in a sense, was that we, as opposed to some other countries, decided to front-load the fiscal austerity measures. So basically, the main fiscal adjustments for many percent of GDP were actually done in the first 2 years of the crisis, rather than postponing them for later. Okay,
so how did the recovery come about? Has there been a key to Latvia climbing out of that crisis?
Last year, we just had new data, 5.5% growth last year, and fastest growth in Europe in the last quarter, 5.7%. So we expect to be growing the fastest in the first 2 quarters of this year as well. Now, how did that come about? Really, it is an adjustment, both fiscal adjustment that the government made, but also the private sector adjustment. What has happened is that we have been able to change substantially the structure of our economy, only in a way that a small, open, very agile economy can do. So basically, from internal consumption, non-tradable sectors, we are now switching to a larger share of tradable export sectors. Manufacturing is back on the wave. Our exports have been growing for 2 years in a row, roughly about 30% year on year. Same applies to industrial output. So now we are back to the model of export-led growth.
And what does Latvia export? Again, this is, I'm sorry to be naive here, but we don't hear much about your country. What do you offer to the world?
Now, our country is very rich in wood, first of all. It's one of the richest in that sense in Europe. It's one of the greenest countries in the world. I think in a recent assessment of some sort, Latvia came out second in the world in terms of being the greenest countries. Half of our territory is high-quality wood, pine, spruce. We have lots of agricultural land, and we have actually inherited quite a lot of industry, which has over time now adapted to new environment. So what we export is basically wood products, more advanced wood products like plywood, furniture, wooden constructions, houses that can be made out of prefabricated houses, basically. Just an example. We have machinery metalworks. We are actually growing very well in food production based on our agricultural output. We are actually quite active as a finance sector. Tourism is growing. And
but where's your market? Because you've got Europe on you. Well, you're in the European Union. You've got the whole of Europe on your doorstep, but Europe isn't doing much buying at the moment.
Well, actually, it's not that bad. It depends who you trade with. Essentially, 70% of our exports is the European Union. That's obvious because we are sandwiched between EU, European Union on one side, and CIS countries, Russia, Ukraine, Belarus, Kazakhstan on the other side. So we have traditionally been a hub marketplace for those two sides. So, and that continues to be so. Transit logistics is very big in our country. We have big ports, non-freezing ports, which turn around about the same amount of cargo as, for example, United Arab Emirates, or actually a little bit more. So in that sense, that's the marketplace. Now, 70%, as I said, is EU. Much of the rest is CIS countries. But now our companies are looking for new markets, which is exactly why, as a part of official delegation led by Prime Minister, we are here in the Gulf states to open doors for our businesses in various sectors, both industry and manufacturing sectors and services.
You are in the European Union, you are pegged to the euro. Is there any thought about taking that next step and joining the Eurozone?
Oh, absolutely. That's our big objective. Even
with the state that things are in now?
You know, there are benefits of being part of the Eurozone. You could actually say that by being pegged to euro for many years now, we have all the downsides of being fixed to euro without the benefits of being in the Eurozone, meaning the additional safety of having the same currency, of having ECB at your beck and call, and etc.
Yeah, but look at the difference. And you and, say, Spain, for example, had similar problems, similar levels of unemployment, and yet it was Spain which got hit very hard and more publicly, if you like, because of that fear of contagion, that constant fear that with the shared currency it moves around a lot faster. You were, I'm not going to say you were insulated from it, but you didn't have to worry about that so much.
We had different worries. Our worry in our economy was devaluation. I mean, actually financial markets expected us to devalue, so basically break the peg to the euro. And there was a fear, actually, by international bodies, I would imagine, that there would be certain contagion in that region with regards to those other small currencies which are pegged to euro one way or another, and that this would actually cause devaluation massively in the region. So Latvia was important in that sense that that had to be stopped. And we asked IMF for help and additional finance and a loan program. And we are one of those few countries that can say that we concluded it. It happened at the end of last year, around Christmas time, and both IMF and ourselves say that it's been closed successfully.
Good for you, good for Latvia as well. Minister, thank you for your time. It's been a pleasure.
Thank you, it's my pleasure.
To Russia, which is settling into a new/old reality of having one Vladimir Putin as its president. One thing that's certainly looking familiar to a lot of Putin's critics is the cosy relationship he has with big business. Charles Stratford takes a look now at the president-elect's rich and powerful inner circle.
It's nearing the end of a harsh winter in Moscow, a winter that saw Vladimir Putin elected as president for the third time. Many in the opposition say changing those who walk the Kremlin's corridors of power means daring to confront a network of allegiance stretching deep into billion-dollar business deals. Vladimir Milov worked in Putin's government during his first term as president. He is now a prominent opposition figure.
In the large sense, a symbiosis of politics and vested interests, you never know who serves what. And basically, to a large extent, Putin's actions in internal and external politics have been driven by the desire to protect certain special vested interests, protect specific businesses.
So who are some of Mr. Putin's big business allies in Russia? Arkady Rotenberg, estimated worth $1 billion, former judo coach and one of Putin's sparring partners. He made his fortune selling pipe to state-owned gas giant Gazprom. Yuri Kovalchuk, estimated worth $1.5 billion. He owned a small stake in a minor St. Petersburg bank that won control of Gazprom's subsidies. And Gennady Timchenko, estimated worth over $9 billion. Co-owner of the trading company Gunvor, which moves crude oil through contracts with the national oil company Rosneft. Anti-Putin protests in the run-up to the presidential poll made their demands for greater accountability and rule of law loud and clear. Putin has repeatedly denied he helped make friends and allies rich.
Despite the very fractured nature of the fledgling opposition movement here in Moscow, one thing that many of them agree on is that there can be no real political change here until what they describe as the system of vested interests among Putin's friends and allies is broken.
Despite the risks for journalists asking questions about big business and politics, opposition figures say the so-called system must be exposed.
he created this small network of people who helped him. All those guys, they became the real pillars of Putin's economy. They are right now stealing all the money from our budget. About this financial interest, everybody is keeping silence except for Novaya Gazeta, and that's why they have so many murders of journalists.
After initially dismissing the protests as being an effort by foreign powers to meddle in Russia's affairs, Putin later said the opposition movement was proof of the freedom that he has cultivated. Freedom to question his politics maybe, but perhaps not to speculate why he is really so determined to stay in power.
We've brought you plenty of stories from Libya, both during and after the revolution, the majority of them focusing on oil. After all, it is where the country's riches lie. It probably holds the key to its economic future. I say probably, though, because one of Libya's biggest private company owners, Husni Bey, reckons it's actually Libya's system of food and energy subsidies, which needs refining. Nicole Johnston met up with him in Tripoli.
It's a fair bet that a lot of the goods passing through Tripoli's port are all using one Libyan company as their agent. HB Group is one of the country's biggest import-export companies. It has dozens of businesses across the country, and one of its strongest divisions is shipping. The post-Gaddafi era may open up new opportunities for Libya's businessmen. But the chairman of HB Group, Husni Bey, says the government needs to do more.
The overall perception, it is better. The expectation of the people are higher. The confidence, it is improved. But unfortunately, little is being done to really kickstart the economy.
But if there's one issue that really gets to Husni Bey, it's subsidies.
You imagine, it's like a honey or a pot of honey, and you have the bees around it and you expect the bees not to just dip in it.
In Libya, basic food like rice and pasta is heavily subsidised by the state. It should be 80% cheaper than market price. It's one of the benefits of living in a country rich with oil reserves. Fuel is also cheap here, about 12 US cents per litre. But a lot of the subsidised food and fuel is being smuggled out of Libya.
The ones who are benefiting most are the smugglers, the thieves, the corrupt, and the people who are exporting, using, abusing the system. So whatever way you read it, something majorly corrupt is happening. And this is a robbery that has been going on for 42 years. It is going on now as we speak, and it will go on forever, unless with a simple signature, the government can change the subsidy from goods to money.
He believes this would cut out the middlemen who are abusing the system. But convincing the public will take some time.
If you're asking to be given a sum of money, what is that based on? Let's say you give me $1,500 to cover food and necessities, and in a year food prices increase dramatically. What do I do then?
The subsidised food isn't sold in supermarkets, only at these local cooperatives. The problem is, though, most of the time they're closed. Now, we've been to two over the last 2 days, and they've both been shut because neither of them have any food to sell. Another product heavily subsidised by the state is flour. This is one area where the subsidy appears to work well, benefiting everyone.
Bread in Libya is some of the cheapest in the world, and that is because of the subsidy. You can buy flour at almost a token price, so there's something for everyone. The fact that some people exploit it, that's to be expected.
There's no doubt Libya has some financial problems. There's a serious shortage of cash in the market. Husni Bey blames this on the massive increase in public servant wages during the last few months of Gaddafi.
The problem today of the shortage of cash in circulation is that the civil servants' wages have gone up from 800 million Libyan dinars to 1.2, and I'm hearing now 1.4, and I'm even hearing 2 billion a month.
Still, there's optimism, and Husni Bey seems confident any investigation into his business empire won't find corrupt links to the former Gaddafi regime.
It was difficult times all through. Considering, just to give you an example, I have been to prison 7 times. And I have resisted, persisted, and stayed and fought on. So it became part of life.
And just before we leave you this week, the details on how to get in touch with us. Twitter's the easiest way to do that. You can write to me at Kamal AJE or our business editor at Abid Oliver Ali. For those of you not so Twitter inclined, email is just fine, counting the cost at aljazeera.net. Also, head over to aljazeera.com/business. You link onto the CTC page at the top. That's where we put all our episodes up in full for you to catch up on whenever you would like. But that is it for this edition of Counting the Cost. I'm Kamal Santamaria from the whole team. Thanks for joining us. The news on Al Jazeera is next.